Everybody tells you to get a fixed interest rate when you buy a house, but I'm going to tell you why. For most people, adjustable rates are actually way better than fixed interest rates. And I'm going to give you an example and teach you how adjustable rates actually work. Say that you take out a $500,000 mortgage with a 6.5% fixed interest rate. This is roughly the 30-year fixed rate for a conventional mortgage right now. You will be paying $3,160 a month. But check this out. Out of the $3,160 that you're paying, only $451 goes towards the actual principal. So the rest, $2,708, are going to go towards interest. Over the course of 30 years, you will be paying $637,000 in interest alone. That is insane. Okay, but maybe you only keep the mortgage for 7 years. If you do, you're still going to pay $217,000 in interest payments alone. Now, let's compare it with the 7-year adjustable rate. Right now, in my company, we have adjustable rate mortgages as low as 5%. On the same loan, the payment would be $2,684 a month. So that is $475 a month cheaper than the 30-year fixed payment. $601 goes towards the principal and $2,083 goes towards interest. That's $624 a month less than the 30-year fixed. And over the course of 7 years, you'll pay $165,000 in interest. That is $52,000 less in interest compared to the 30-year fixed. You see, the bank loves pushing the 30-year fixed mortgages for this exact reason, because you're going to be paying more in the front end. And most people are either too scared or they're just not open-minded, especially millennials who believe they're boomer parents who love to remind us about 2007. But let's talk about 2007. You see, when the housing market crashed in '07, it was partially because of adjustable rate mortgages. Those loans were so much riskier than the ones nowadays, because those interest rates would change you every single month and they had no limits. So yeah, when they adjusted, the payments became unaffordable. Today, all of these adjustable rate mortgages are actually fixed for several years. The most typical, the 5-year and the 7-year arm, meaning that you have 5 or 7 years of the same interest rate. Nothing changes. And there's actually one that's fixed for 10 years. And okay, so what happens after the 5th or the 7th year and the rate becomes adjustable? Guess what? They have caps on how much they go up and they can go down depending on the market. And you still have the ability to refinance out of them before they start adjusting on you. By the way, statistically speaking, most people keep their mortgages for 5 to 7 years only. So when you get a 30-year fixed mortgage, all you're doing is putting a premium on yourself for a loan that you're really never going to use. And obviously, when you fix an interest rate for 30 years, the bank is going to charge you more. So guys, just do your homework. I'm a mortgage broker, and if you have any questions about the best way to get a home loan, comment or send me a DM, and make sure that you follow me for more real estate content.